Oil choke points are closing, AI trades are leveraged, and volatility is creeping higher even as headline indices look calm. This is vTalkInsight, Equity Pulse Daily for July 21st, 2026, where we connect the macro shock from the Strait of Hormuz with a crowded AI trade and shifting sector leadership across global equities. The starting point for today's equity backdrop is the energy shock coming out of the Middle East. Shipping through the Strait of Hormuz has largely stopped after a series of vessel attacks. Visible Persian Gulf exports have fallen to less than half of normal, and Brent crude has pushed above $90 per barrel. Markets now see a binary path for oil, with either a ceasefire or further escalation potentially swinging as much as 5 million barrels per day of supply, and even talk of Iran imposing a toll that could add around $1 a barrel. Jet fuel prices are already above $100. European gas storage looks unlikely to reach 70% before winter, and UK officials are being briefed on scenarios where crude could reach $150, all of which reopens inflation and growth risks. Against that, recent U.S. inflation data have softened, yet front-end Treasury yields remain near 4.2% and Federal Reserve communication screens as the most hawkish since 2022. The prevailing view is still that the Fed stays on hold through year-end, with disinflation outside energy and a non-inflationary labor market giving cover, but a persistent oil shock would test that stance and potentially their credibility if rhetoric stays hawkish without action. The U.S. dollar remains well supported by geopolitical risk, higher energy prices, and a relatively stronger U.S. macro picture than Europe or Asia, while sterling has also held up thanks to high yields and better-than-expected UK growth. Yet several participants described the current equilibrium as unstable, with stable headline asset prices masking fragility in rates and currencies, warnings of a sharp pullback after any bounce, and volatility measures drifting toward the high teens even as the S&P has only eased modestly in recent sessions. The second big pillar for equities is the AI and technology complex, which remains both the growth engine and the main source of downside risk. Margin debt tied to U.S. tech is up about 50% year-on-year. Positioning in AI-related names is increasingly crowded, and widespread use of leveraged ETFs and zero-day options raises the risk of highly correlated, rapid sell-offs if sentiment turns. Technically, the Nasdaq 100 has slipped below short-term support. Its 50-day moving average is rolling over, and semiconductor stocks are down roughly 20% from June highs, with an AI-themed ETF off nearly 19% from its peak. Semis and AI hardware names have led recent declines, even as chip stocks like Intel show signs of bouncing on hopes for positive earnings, illustrating the tension between near-term price pressure and a still bullish long-term AI narrative. On the fundamental side, the CapEx wave remains enormous, with hyperscalers projected to spend over $800 billion next year as demand for computing power stays effectively insatiable and firms such as Meta even explore leasing out spare capacity. AI-related corporate bond deals now account for about 18% of investment-grade issuance this year, and despite that supply, spreads remain tight, and there has been little equity market pushback on big tech CapEx plans ahead of earnings. At the same time, CEOs are increasingly questioning whether current AI spend on tokens and infrastructure is delivering enough value, and there are rising concerns about political risks to data center expansion and the potential for a China shock from cheap foreign compute. Given estimates that AI may be adding 30 to 50 basis points to GDP growth, a slowdown in that CapEx would not only hit suppliers, but could also weigh on the broader U.S. growth story, which keeps this theme central to the equity outlook. While equities debate the AI and energy shocks, credit markets continue to broadcast remarkably loose financial conditions. Investment-grade issuance remains heavy, with around $45 billion priced last week, deals often 4 times oversubscribed, and average spreads holding below 80 basis points alongside 12 consecutive weeks of inflows into high-quality corporate bonds. Banking stocks have rallied for 7 straight weeks, some to all-time highs, helped by strong trading revenues, robust IPO and debt issuance pipelines, and a regulatory backdrop that has allowed traditional lenders to regain share from alternative asset managers. Bank of America delivered about 30% earnings growth while reducing headcount yet still hiring in key areas. Mortgage production is up 30% this quarter, and combined with firm consumer spending and low jobless claims, that underpins a more constructive tone on parts of U.S. consumer discretionary. Small-cap equities are now in their 16th consecutive month of outperformance, supported by a turnaround in earnings helped by earlier Fed easing, AI-driven productivity gains, reshoring, deregulation, and favorable tax policy. Despite that, flows into small-cap ETFs remain negative, suggesting lingering investor skepticism and an under-owned trend, even though history shows this part of the market tends to experience larger drawdowns alongside higher long-run return potential. In Europe, the picture is more mixed. Energy stocks are benefiting from oil above $90 and are modestly higher despite broader equity weakness, but travel and leisure names are underperforming sharply as airlines sell off on fuel and demand worries. European indices opened with a negative tone, reflecting concerns over Chinese competition in tech, higher oil-driven moves in local bond yields, and added uncertainty from UK political change, even though sterling remains resilient on yield support. The competitive landscape in AI itself is evolving quickly and has direct implications for equity leadership. Chinese firms such as Alibaba and Moonshot have launched trillion-parameter models, including Moonshot's Kimi K3, that are approaching the performance of leading U.S. frontier systems at up to 90% lower cost, and Alibaba's latest upgrade helped lift its shares by around 3.5%. A Chinese AI startup is preparing a Hong Kong IPO that could value it near $30 billion, signaling strong capital market appetite for non-U.S. AI champions. Enterprises are increasingly experimenting with lower-cost Chinese and open-weight models, with some estimates suggesting they already account for a substantial share of token usage as firms test options before committing to providers like OpenAI or Anthropic for production workloads. U.S. policymakers are weighing restrictions on advanced AI models for China and have even discussed adding Chinese labs to the entity list, which would significantly limit corporate access to those tools and add another layer of geopolitical risk to the AI supply chain. At the same time, competition from open-source and sovereign models in allied countries is expected to pressure pricing but may not dislodge leading U.S. models, shifting the strategic edge toward infrastructure providers and firms with proprietary customer data and relationships. As models commoditize and pricing shifts toward outcome-based structures that charge per business result, the market is increasingly focused on dispersion rather than treating big tech as a single trade. Upcoming earnings from Google, Microsoft, and Apple are seen as pivotal for testing whether heavy AI and cloud investment is translating into revenue and margin follow-through, with Google in particular expected to post the fastest hyperscaler growth and a strong contribution from search. Company-level reports are already showing how the energy and geopolitical backdrop is feeding into earnings. Ryanair reported a 34% profit decline in its fiscal first quarter, citing higher jet fuel costs and softer travel demand linked to Middle East conflict, and management now expects a winter shakeout in European airlines as weaker carriers struggle with higher costs and fragile balance sheets. By contrast, Boeing is leaning into strong long-term demand, planning to lift monthly output of the 737 from 47 to 63 and the 787 from 8 to 10, supported by a forecast for 44,000 new aircraft over the next 2 decades. Simultaneous growth in civil and defense aerospace is already straining Tier 2 and Tier 3 suppliers, while rising European defense budgets and a shift at major airshows from civil orders toward defense procurement point to multi-year opportunities for manufacturers on both sides of the Atlantic. In financials, Bank of America's earnings beat and efficiency gains underscore how technology and automation are boosting profitability, even as the bank continues to hire and redeploy staff rather than simply cutting headcount. Looking ahead, the U.S. Genius Act, which will require large stablecoin issuers to be federally regulated from early 2027, could eventually allow major banks and capital markets firms to treat stablecoins as digital cash, potentially expanding that market to several $1 trillion and reshaping payment rails. On the consumer side, Domino's delivered a more than 7% share price jump after stronger than expected order growth, signaling that pockets of spending remain resilient even as broader sales data look softer. And in IPOs, the upcoming Jersey Mike's deal, backed by Blackstone and targeting around $8 billion in equity value, highlights renewed interest in consumer-facing names just as new issuance begins to tilt away from pure AI and infrastructure stories. Putting this together, equities are trading between an escalating energy shock and an AI boom that is still driving capex, credit issuance, and growth, but now shows clear signs of crowding, leverage, and rising policy risk. Sector leadership is rotating. Banks, small caps, select consumer and European energy stocks look resilient, while semiconductors, AI hardware, and airlines bear the brunt of higher oil, geopolitical tension, and stretched positioning. From here, the key signals to watch are developments around the Strait of Hormuz and Ukraine, upcoming U.S. inflation data and central bank messaging, and earnings from the major cloud and AI platforms, especially Google, alongside capital spending guidance across tech. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.